Welcome to Teacher Plus. Today we are discuss about accounting principles. Accounting principles means rules and procedures which are followed by the organization when the accounts are prepared. Here the different type of methods of accounting is followed by the different organization on the basis of the situation, but we have to follow the some of the uniform accounting principles which is given by the gap, generally accepted accounting principles. Here accounting principles means or refers to fundamentals or general truth which once established does not change. The accounting principles of GAAP is divided into two types, that is accounting concepts and accounting conventions. Accounting concepts, here accounting concepts means assumptions of accounting. When we are preparing the accounting, some of the assumptions or conditions should be followed. That is, here the accounting is depending upon the some of the assumptions and conditions. Here some of the important assumptions or conditions or concepts of the accounting. There are a different type of accounting concepts, but the most important concepts of number 1, business entity concept, going concern concept, cost concept, money measurement concept, dual aspect concept, accounting period concept, matching concept, accrual concept, etc. There is a different type of accounting concepts. First one is the business entity concept. Business entity concept. According to the business entity concept, there is a two separate entities, that is business is separate and owner is separate. Yes, according to business entity concept, there is a two separate entities, that is the business and owner. Yes, here the business is separate, owner is separate. All the business transactions are recorded in the books of account with the business point of view. If we are not following this concept, all the personal transactions are mixed with the business transactions. In that situation, there is very difficult to find out the true or fair profit, fair results of the business organization. Here, if here business entity concept, here we are followed the business entity concept. Here the amount which is invested by the owner is treated as a capital. Capital is the liability to the business. Always we are treated as it is liability. Capital is the liability to the business organization. In the same way, if any amount or cash is withdrawn by the proprietor or owner from the business, it is treated as a drawings. Yes, when we are not followed this business entity concept, all the personal transactions are mixed with the business transactions. So we have to assume that is business is separate, owner is separate. Next one, dual aspect concept. According to the dual aspect concept, there is a two aspects or twofold aspect in this double entry system. Every receiving benefit is equal to giving benefit. Every receiving benefit is equal to giving benefit. For example, we are purchase of machinery for rupees 1 lakh. In that situation, here when we are purchase the machinery comes in, that is receiving it. Receiving benefit is machinery. Yes, giving benefit is the 1 lakh rupee. So here according to dual aspect concept, every receiving benefit is equal to giving benefit. Yes, here same value given. This concept is also known as a accounting equation concept. Yes, accounting equation. The total accounting is depending upon the accounting equation. Accounting equation is the relationship between assets, liabilities and capital. Here the accounting equation is equal capital is equal assets minus liabilities. Capital is equal assets minus liabilities. Then next one, going concern concept. According to going concern concept, we are assumed that the business will run a long time with high profits. In that situation only, we are maintain the books of accounts properly. When we started the business, we are assumed that the business will run a long time with high profits until it is dissolved. For this reason only, fixed assets are recorded with the actual cost of the asset, and we have to calculate the depreciation on these fixed assets. Then next one, cost concept. According to the cost concept, we are record only actual cost of the asset. Yes, we are not record on the basis of the performance of the asset, and also we are not record on the basis of the market value. Why? Because here market value will be fluctuated. That is, the market value will be increase or decrease. But whenever you purchase, you have to record the actual cost of the asset only. For example, purchase of machinery. When we are purchase the machinery, the cost is 1 lakh. Yes, the machinery is purchased yesterday. Here today's market price is 1,50,000, but we are record only 1 lakh. Or today's market value is 50,000, but we are record only 1 lakh. That is, we are not record the market price, only we have to record cost price of the asset. Next, money measurement concept. According to these concepts, the transactions which are measured in the monetary value only we have to record in the books of accounts. That is, here the transactions are two types: monetary transactions, non-monetary transaction. Monetary transactions means purchase of goods, sales, wages paid, etc. All these are monetary transactions. Non-monetary transactions means performance of employees, performance of management, services, etc. is the non-monetary transactions. Yes, according to money measurement concept, the transactions which are measured in the monetary value only, we have to record in the books of accounts. That is, non-monetary transactions are not recorded in the books of accounts. The next one, accounting period concept. Yes, every businessman is interested to know the profit or loss of the business organization. That is the financial results of the business organization. Here, there is a sum of the short intervals. Intervals are divided and the every interval is called as a accounting period. Generally, in this accounting, we are adapt to the 12 months duration period. 12 months duration period is called as a accounting period. That is either calendar year or financial year. Calendar year means it begins from 1st January and ends on 31st December of same month. Financial year means it begins from 1st April of this year and it ends on 31st March of next year. Whatever it may be, in this accounting, most of the organization adopt the 12 months duration period. That is, 12 months duration period is called as a accounting period. And next one, accounting conventions. Accounting conventions refers to customs or traditions or practices followed by the accounting. Here, when we are prepare the financial statement, some of the customs, rules and regulations we have to follow. First one is the convention of consistency. Consistency means stability. Consistency means stability. According to these conventions, when we are followed the one method, we have to continue the same method for every year. In that situation only, there is a chance to compare the business results from one year to another year. If we are not to follow the convention of consistency, that is same methods and rules and principles of the accounting, it is very difficult to compare the business results from one year to another year. For example, for the calculation of the depreciation or for the provision of the depreciation, if we are adapt to the straight line method, in that situation you have to follow the same method for every year. If one year you are follow the straight line method, next year you are follow the diminishing balance method, it is very difficult to compare the business results from one year to another year. According to convention of consistency, we have to follow the same methods and rules of the accounting for every year of the accounting. Then next one, convention of the disclosure. According to this convention, we have to full disclose all the material facts of the business organization. That is, all the business transactions we have to discuss. All the business transactions we have to discuss clearly. For example, in every business organization, there is a chance to credit transactions. That is, for example, in this business organization, some of the cash transactions and some of the credit transactions. In that situation, we have to record the debtors. If any goods are sold on credit basis, the terms are treated as a debtors. We are not only record the debtors, we have to record the provision for doubtful debts also. That is, total how many bad debts is there, how many good debts is there, you have to discuss Yes, the next one, convention of materiality. Yes, here we have to record only the transactions which are related to our business only. Unnecessary items or other related items are not recorded in the books of accounts. Unnecessary items are recorded in the books of account. It is overburden to the accountants. As per this convention, we have to record only the transactions which are related to the business. We have to record in the books of accounts. That is, unnecessary things are not recording in the books of accounts. Next, convention of conservatism. Here, according to this convention, we are playing safe. Here, this convention is based on the policy of playing safe. Yes, according to these conventions, when we are record the books of accounts, unearned incomes are not recorded, but possible losses have to record in the books of accounts. Yes, for example, here when we are valuation of the closing stock, that is actual price or cost price, market price, whichever is least. Here when we are calculating the closing stock, we have to take whichever is least from the following, that is cost price and market price. Whichever is least we have to take for the calculation of the closing stock. Next, accounting process. Accounting process means step by step or sequence of the accounting. Here, accounting is a language of business. Accounting is a language of business. But here all the business transactions are recorded in the books of accounts in a following way. That is, here first of all we have to follow. Yes, first step of the accounting is bookkeeping. Bookkeeping means recording of the business transactions. All the business transactions are recorded in the books of accounts is called as bookkeeping. In this bookkeeping, daily transactions are recorded. Yes, for example, in this daily we have a 20 transactions. All these 20 transactions simply we have to write in bookkeeping. That is purchases, sales, payments, etc. We have to record in bookkeeping. On the basis of the bookkeeping information, we have to prepare the journals. Journals means daily record all the business transactions which from the bookkeeping first recorded in this journal. So journal is called as a book of original entry or book of prime entry or book of first entry. All the business transactions are primarily or first recorded in journal in a chronological order. Chronological order means date wise, time wise, situation wise. Here for example, first transaction is recorded first, second transaction is recorded second, third one is recorded is third. That is, chronological order is used to record the accounts. Yes, the process of recording of the journals is called as a journalizing. Yes, on the basis of the journals, we are posted or we are prepared the ledger accounts. The transactions from the journal to ledger, transfer the transactions from the journal to ledger is called as a posting. Here, the transactions are firstly primarily recorded in journal and finally recorded in ledger. So ledger is called as a book of final entry. Here from this journal we have to know the each and every account accurate status. Each and every account accurate status. Yes, the ledger accounts, on the basis of the ledger accounts we have to prepare the trial balance. Trial balance is the statement of balances of ledger account. Ledger account balances are recorded in trial balance. Here trial balance is a statement which is prepared for the purpose of to know the arithmetical accuracy. Arithmetical accuracy. Yes, here trial balance always shows the debit balances are equal to credit balance. Yes, always shows the equal balance, that is debit balances are equal to credit balance in trial balance. Finally, here trial balance is prepared for the purpose of to know the arithmetical accuracy of the ledger accounts. Ledger accounts. Then next, on the basis of the ledger accounts we have to prepare final accounts. It is the final step of the accounting. Yes, in this final accounts we have to prepare manufacturing account, next trading account, profit and loss account, and last one balance sheet. Yes, every businessman is interested to know the financial results of the business organization. From this manufacturing, trading and profit and loss account we know the profitability of the business organization. From this balance sheet we know the financial position of the business organization. Very simple. In this final accounts we are prepare the manufacturing account, trading account, profit and loss account and balance sheet. From this manufacturing account, trading account, profit and loss account we know the profitability of the business organization. From this balance sheet we know the financial position of the business organization, that is how many assets is there, how many liabilities is there.